Good morning. This is investing in hard assets in a digital world. This is going to take you on a journey that I started a few years ago and how I got into real estate investing, how I started doing passive investing, and how I think this is the best investment vehicle for today's economy and for the world going forward. I'm going to jump right into this. So let me just share my screen here for just a moment. Give me a second to get this up, and we'll jump right into it. Okay, everyone should see the screen share there. This is investing in hard assets in a digital age. We're talking about timeless principles, but there's a new playbook. In case you haven't noticed the last few years, the world is changing and is changing quite a bit, and your investment strategies need to change with this. Before we get started, let's do a quote from Warren Buffett, one of my favorite people. Wall Street's the only place that people ride in a Rolls Royce to get advice from those who take the subway. So I have made a lot of money on Wall Street. I'm not saying don't be involved in the stock market. What we're going to talk about today is ways to diversify outside of that stock market and have things in real estate, even if you don't want to manage properties. And even if you are not a person who wants to deal with the day-to-day management on these properties. A little bit of a disclaimer first. This presentation is for educational purposes only. I'm not providing legal, tax, financial, or any other type of advice. Investors should consult their own professionals in these areas to determine if investments are suitable for their unique situation. This presentation and document contains confidential information, not to be shared or represented with anybody else. All investment have risk. Understand your risk profile before investing. We're not guaranteeing investment results or outcomes based on this presentation as related to real estate investing. And nothing in this document is reviewed or approved by the Securities Exchange Commission. On this presentation, we're not doing an offering. We're not selling securities. I'm not going to have any kind of a deal involved with this. Okay, so let's talk a little bit about how the landscape has changed. This is what we're going to cover today. I'm going to tell you my story, and I'm going to tell you the 5 game changers that I discovered that changed my mindset. And this is something I wasn't taught, and I was very, very well versed in traditional type of investing, traditional type of assets. The second thing we're going to talk about is what to do about it. Okay, what is real estate investing? How does it work? And why is it a necessity to be part of your portfolio? And then how to invest in alternatives. So I'm going to talk about how I invest, how I bring investors in. I'm going to talk a little bit about my deal method, which is my proprietary method to stay out of bad deals. And then the next steps so you can get started. The first thing I'm going to talk about is mine and my wife's story and what we wish we had known and how we wish we had gotten started a little bit earlier. We got married in 2008. This is a picture from our wedding. For all of you people that think this picture might be edited, I can assure you it is not. It is not photoshopped. The rainbow is very, very real. We got married in Kima on a yacht in 2008, and it was raining before the wedding, and it looked like it might be kind of messed up, like our weather had plans. But as soon as we started sailing on Galveston Bay, a rainbow came out, provided some amazing pictures, and it just seemed like this was going to be a good sign for the start of our lives. So we got married in 2008. We're building a future together. We were dreaming big. We just got married. It was a very, very exciting time. Probably the most exciting time in your life is when you're newlyweds. We're saving for the future. This is 2008. Remember, that's going to come into play here in just a moment. Following the traditional models, and we followed that traditional route. We did this after 2008 for about 12 years. And obviously, once we got married, the stock market crashed. It went down from about 14,000 on the Dow to about 6,500. So that was a really bad situation for most people, but we were able to take advantage of this. We were newlyweds. My wife was working in oil and gas. She had a very, very good W-2 job, was making a high income. And I had just started my mortgage company, gone out on my own. So we decided that we were going to save all my money from my mortgage company and that we were going to basically live and budget off of her income. So that was our plan. It went very, very well until three things happened. The first thing that happened in March of 2020 was the pandemic really hit. I know COVID was before that, but March 2020 is when they really started shutting everything down. So we were on a ski trip for spring break. One day, all the resorts were closed. We had to go back home. We barely made it back. It was kind of a panic city getting back. And I don't want to talk about the politics of the pandemic, but I want to talk about the effect on our personal finances. At this point, we had been on a huge bull run from 2008 or 9 when we first got married right until 2020. We had made probably a 5x on a lot of these investments that we hit early on. And we were doing incredibly well. We were really getting set toward retirement. What happened during the pandemic is for about 3 months, our portfolio got cut in half. So for us, we were seeing 7-figure swings in our portfolio because of a virus. And this was an unexpected black swan. And after that happened, I really panicked a little bit about the stock market and thought, well, what if this happened when we were retired? Or what if it happened when we were older? What if we had our retirement in place and thought we were set and we got cut in half? We didn't sell. The market did eventually come back, but this was the first thing that really made me lose confidence in the strategy that I was following. January of 2022, cancer disrupts our plans. I came back from the trip from this picture. We were skiing in New Mexico, doing some horseback riding in the snow. I'd been a little tired, went in to get a blood test for a physical. My doctor called me that afternoon and said, you have cancer. He was just very direct telling me. And he goes, I don't know how bad it is, but you need to get down here at 9 o'clock in the morning in oncology, talk to the oncologist, and we need to figure out what you're facing and how bad this is. I had been a pretty healthy person up to that point. I'd never spent a night in the hospital since I left as a baby. I was doing everything right as far as most health protocols. And so this was a big deal to us. So the reason it was very disruptive was at this time, we were starting to look at transitioning to maybe doing real estate. My wife had left her executive job to spend more times with our kids. And we really didn't have our cash flow set up yet. So I couldn't work for a few months while I was doing chemotherapy. I took about 4 months off. I wasn't sure how sick I was actually going to get. And I thought it was unfair to my clients to try to work in my mortgage or real estate business. So I took 4 months off to take care of my health. My wife wasn't working. And so during that time, we had a 4-month traditional retirement. And what I mean by that is the markets had come back. Our stack of money was way up there. I had enough money where Dave Ramsey said I had plenty of money to retire. And we all of a sudden were not working. And we started drawing off the top and clipping off the top. And so I was retired for a few months. And I can tell you, if you're following that traditional model, when you quit working and you've got a big stack and you start cutting off the top every month and you see that amount going down, it is panic city. So I was retired once, and I don't plan on retiring the same way ever again. And this has been a problem I've seen with everybody that's followed that model. You work hard your whole life, 401ks, IRAs, or whatever. And then everyone in retirement that I've talked to that follows that model is worried about money. They're worried about losing money, and they're almost hoping they die before they run out of money. And so it's a very, very difficult thing. But this cancer that came in my life was a great gift. It changed my mindset, maybe changed my model. My experience with cancer, I was extremely lucky. I only did the 4 rounds of chemo. I didn't lose my hair, didn't get real sick. I don't want to compare my experience with other people because I think over 99% of people have an experience that was much worse than mine. But I got the mindset change without getting real sick, and I'm very grateful for that. I'm healthy now. The third thing that happened is right around the time that I was dealing with cancer and taking time off, inflation happened. People had forgotten about inflation. Everybody thought inflation was something we'd whip back in the 80s when Ronald Reagan was president. And we hadn't dealt with it for almost 40 years, really. So 2022, inflation skyrockets. The government says it's 10, 11%. It was more like 20 or 30 if you were grocery shopping. So the dollar was becoming worthless. Once again, this is during a time I'm not working and I'm seeing my market portfolio get clipped. And people that were in that traditional 60-40 with stocks and bonds, they got hit hard too. Bonds got creamed. And people thought that bonds were a safe investment, safe cash flow. 2022, when inflation hit, they aren't. And I've got news for you. Inflation is here to stay. It's never probably going to go back the way that it used to be. This is something we're going to be dealing with in the future because we've got a $38 trillion deficit that a debt the government owes back. It owes us, owes itself, owes other people. We're going to be dealing with this basically forever. So that part of the world has changed. So the moral of the story from these three things were trading time for money and heritage strategies were not working for us. So my wife, working the corporate job, had been working, I wouldn't say 9 to 5. She was probably working 50, 60 hours a week, most weeks, sometimes more. And for me and my mortgage company, I had to work to earn money. I had no money on the side working for me. So these strategies were not working for us. They got us to a certain level, but at the level we were at, we were still very insecure and we wanted to get to a level where we had financial freedom. Black swans and inflation compromised our saving strategy. COVID cut it in half. It recovered. Then inflation came. The markets get hit again. I'm not working. So this was a very, very, very scary time for us. And then we needed a new investment strategy to fuel our dreams. Okay. So we started looking at what else can we do to help us reach another level where we feel totally financially free. So one thing that we looked at is like, wow, our deals we had done on real estate. Now, we had never owned single families as investments, but we had primary residences. And when we sold these properties, we always had fantastic returns because they were leveraged. So we started looking at real estate and wanted to add real estate into our portfolio. The key here, and this is a quote from Albert Einstein, you can't solve a problem with the same mind that created it. So we needed a complete mindset shift to get basically where we needed to go. So our principles remained, but our strategy had to change. We wanted to invest conservatively. We wanted to invest long-term. We wanted to invest passively, but we needed a new strategy. So there's 5 fundamental changes to the rules of the game that you have to know, that you have to implement into your strategy. Number 1 is 1971, the lifting of the gold standard. Okay, this is a huge thing that a lot of people are not aware of. The dollar, the green you have in your wallet, is no longer a hard asset. So you can create money out of thin air. The US government has created $38 trillion in extra debt out of thin air. And if you look at this $1 bill very carefully, this was a $1 bill from 1957. It says $1 in silver payable to the bearer on demand. So that dollar bill was linked to silver. It had some hard asset behind it. After 1971, the lifting of the gold standard, that basically ceased to exist. 2009 plus markets began to correlate. So this started compromising the long-held 60-40 strategy, allocation strategy. And it also, I had invested in index funds in REITs. So this was something that I was taking part of, that I was doing. And what I saw was that REITs started becoming more correlated with the stock market. They weren't a good diversifier. It was risk on or risk off. Okay, 2012, the Jobs Act regulates syndications. Now, we weren't in syndications back then, but after the financial crisis, the government started getting back involved in regulating syndications. And this provided an avenue for people to go raise money on large projects. And there was now a set of rules. There were protection for government investors for from the government. So the government was coming in, they were going to set rules, they're going to protect investors. And it gave us a playbook that we can invest in real estate passively. Okay. 2020 plus, AI dominates the public markets, and this increases market correlation and it skews the S&P. So several things have happened. So obviously, AI is making trading at the speed of light. Okay. So if you're a person that thinks I'm going to go in and trade in the stock market and I'm going to beat the market, you're not as fast as AI. You can't make the split-second decisions. These decisions are being made in milliseconds now. I saw a thing a few years ago where companies that are using high-speed trading with AI, they're moving their servers closer to New York. They're right across the river in New Jersey, their data centers, because they need to be within a mile of Wall Street to be faster than everybody else. So this increases the market correlation, and this skews the S&P and makes everything very, very efficient in the markets, in the public markets, but it makes it very difficult to make money in the stock market. You're just kind of along for the ride. Definitely trading in the stock market is no longer a strategy, in my humble but correct opinion. 2025, things start changing in the real estate market for apartments, which is the main market that we operate in. Bonus depreciation legislation passes. This is part of that big, beautiful bill. This enables unprecedented tax savings opportunity that President Trump passed. Now, whether you agree with the politics of President Trump or not, it doesn't matter. He is a real estate president. He is the most real estate friendly president in history. And this bill allows you to take bonus depreciation, to take acts of offsets, and it allows you to get into real estate and take advantage of tax benefits in a way that's never happened before. Okay, the implications to adapt your strategy to 2025 plus. First of all, get educated. That's a lot of what I do. That's some of what I'm trying to do this morning. Get as educated as you can about these markets. Number two, get truly diversified, okay? A mixture of stocks and bonds is not being truly diversified anymore. You need real estate in your portfolio. And if you're like me and don't want to manage properties, they're all alternatives, okay? And then get your money working for you. You need to have money working when you're not, so you're not trading time for money anymore. Okay, so let's talk about real estate investing for a minute. And this is a quote from Andrew Carnegie, the wealthiest person of his time in the United States. And he said 90% of all millionaires become so through owning real estate. More money has been made in real estate than in all industrial investments combined. The wise young man or wage earner of today invests his money in real estate. Okay. 3 ingredients to a successful real estate deal. So when you want to go invest in real estate, what do you need to make this deal successful? 3 ingredients. And these are in every deal, whether you're doing single family, multifamily, commercial, shopping center, it does not matter. Number 1, time and effort. Okay, somebody has to do the work, okay, in the deal. It doesn't have to be you, but someone's got to put time and effort into a deal. Number 2, expertise. Someone has to make the right decisions to be successful. So you can be putting in a lot of time and effort. You can be hustling, but if you make the wrong decisions, if you make mistakes, it doesn't matter. Okay. So you need somebody who has expertise is making the right decisions. And then number 3 is you need money. Okay. If people say, oh, you need no money, you can get real estate with no money. You have to have money. Now it could be other people's money, but money has to be involved. And in real estate, we look at debt, which are loans, and equity, okay, which is down payment, money we borrow from investors or money that we use ourselves. Now, which of these do passive investors provide? And the answer is number 3, but it's equity only. Okay, so as a passive investor, you're bringing money into deals. You're not putting in time and effort other than researching the operator of the deal. Once you get going on the deal, you're not doing that at all. So it's perfect for people that want to be retired or people that are busy professionals. As a limited partner, investing in these deals passively, you're not making decisions. You're hopefully getting people that are very, very experienced, that are experts, and they're making decisions. And as far as the money, you're not acquiring debt, you're not signing on loans, you're just providing equity, and they're signing on the loan, they're making the decisions, and they're doing all the work, and they're trading their time in the investment and their effort. Okay, so why passive investment versus active if you're looking at which one you should do? Okay, rentals are kind of a do-it-yourself. You have to be a jack of all trades to be successful at it. I never bought any single-family rentals during the time that I was investing in the markets after I got married up to 2020. And it's because even though I was a real estate broker, even though I was a mortgage broker, I was a little bit terrified, or maybe a lot terrified, of actually managing properties and dealing with all that. Plus, my wife was working full time. My mortgage business was very, very busy. I just didn't have the time to do it. And I think with single families, especially with a small portfolio, you have to manage it yourself. It doesn't really make a sense to hire a manager and you only have 2 or 3 properties. So it's a lot of work. You have to do it yourself. Total respect for people that do that. But you have to do a lot of the work yourself, and you kind of have to learn a lot of skills, be a jack of all trades. With rentals, you're still trading some time for money. If there's a problem on the property, people are calling you. If the property is vacant, you got to find new tenants. You've got to get the properties clean. You might have to evict people. There's a lot of work involved in acquiring, managing, and repairing properties. It's basically a full-time job. You can ask anyone that's ever managed properties. I think they'll tell you the same. Number 3, mortgage debt. Now, unless you have a whole lot of cash and are going to write checks for all these properties, you've got to go sign for loans. And typically on mortgage debt for rentals, it is recourse, which means if you default on the loan, they can come after you personally. And you sign on the loan. So if you don't want to go into debt and you don't want to be on 7, 8, 10 loans or whatever you need to build up your portfolio, then doing rentals may not be for you because you've got to sign on the loan. And then rentals, I think, are riskier for inexperienced operators, okay? If you're a first time out and you're trying to buy rentals and manage them and property manage, and you don't come from that background, you have no experience, you are an inexperienced operator and you're going to have to learn the school of hard knocks. I think it's really good on your first few deals to partner with more experienced people. But in rentals, almost nobody does this. So you have to kind of learn the hard way how to do these things. And you're coming from a place of not being an expert. So you can partner and get some help, but it still is a little bit riskier, I think, for inexperienced operators. And you really have to want to go through that period of transition, learning all these different skills. Okay, so why invest in multifamily real estate? Why do we like multifamily, and why do I invest in it? So the first thing is for cash flow, and we are cash flow investors. So when I invest in a deal, I look first is this still cash flowing right now today? And I have the same philosophy as Robert Kiyosaki. He has a famous saying where he says, I'm a cash flow guy. If it doesn't cash flow right now, forget it. Like, he doesn't want to do the deal. So we look for cash flow. We want deals that cash flow now, and we want deals that we can make cash flow better. So right now, we want to plant seeds when you buy a property looking for cash flow. And then this way the strategy works is replacing your accumulation strategy with a cash flow strategy. So when we were doing the traditional IRA 401k, that's an accumulation strategy. So you hope you build up a pile of money and you take your 4% withdrawal rate, which is supposed to be safe, and you hope that you get enough money from that to make your retirement work. So now we have a cash flow strategy. We're not looking at the accumulation or the top number as much as we're looking at the cash flow, because cash flow is what really gives you financial freedom. We look for appreciation in real estate. Does real estate go up over time? Yes, always. Are there periods where real estate goes down? Yeah. During the financial crisis, single families went down for the first time in, I think, about 30 years. Does multifamily go down? Yes, it has. It's been disrupted the last few years, and it doesn't always go up. But if you go out to long time periods, 10 years or more, real estate always goes up in value. There's not even a discussion on that. It's 100%. So it's a great inflation hedge. What I like about the appreciation on multifamily, it's a forced appreciation model. So when we increase our net operating income on a property, the value of the property has to go up. So if I increase the NOI on my property, the net operating income, and we increase it 20%, by default, all things being the same, the property goes up 20% in value. That does not work the same with rentals. So if I buy a rental property and let's say I'm able to cut the expenses and I manage it myself, and let's say I raise rents 20% and I've got 20% more money coming in on the rent, okay, all the costs remain the same. The value of the rental does not change. The value of the rental is based on a comparable sales model on the appraisal, which is basically what can a realtor sell your property for in your neighborhood based on recent sales. So in multifamily, we can go and we can have a plan, we can take over our property, we can make the property better, we can increase the net operating income, and then we can increase the value. And that's something you cannot do in single family. It's not possible. You're a little bit more tied to the market in single family as far as it's basically a comparable sales model. Tax advantages. Now, both types of real estate have tax advantages. As far as single family, multifamily, all commercial does, but multifamily's got amazing tax advantages. Cost segregation. We do this on every single property. It is not even like a question if we're going to do it or not. What cost segregation, for those of you not familiar with it, basically what we do is we take the property, we do an engineering study, costs about $10,000 on a big property, and we divide the different components of the buildings into different schedules, and we increase the schedule for depreciation. So if the roof, life of the roof is 10 years, we depreciate over 10 years instead of the standard 27 and a half. The carpet, 5 years. The concrete in the parking lot could be 10 years. So we take those, we do a study, we divide it out, we get an accountant, and we do cost segregation to increase the deductions we're getting. And then bonus depreciation. This is part of that big, beautiful bill. We can take the bonus depreciation, which is 100% now in 2025 through 2030. We can take that 100% now up front and get those tax benefits immediately. You can do the same thing on single family. I've noticed on single family, very few people take advantage of cost segregation and bonus depreciation. They should be, and they're not. So it's something that is people in single family are not familiar with. When I was doing single family as a mortgage and real estate broker, I'd never heard of cost segregation or bonus depreciation. So if you're doing single families, never heard of this, get in touch and I can maybe help you out, educate you a little bit on that. But in multifamily, we always do that. The people that do large multifamily projects, 20, 30, 40, $50 million deals, which I've done, these people are very sophisticated. They're very wealthy, and they take advantage of every tax trick out there to get the investors and themselves the maximum type of benefit. So it's high impact, low effort, much easy to manage a 100 unit apartment complex than it is to manage 100 single family rentals. And I think anyone that's a property manager or has ever tried to do that would agree. So it's much easier, lower effort to manage these properties. We make a difference in providing housing. That's when we get all the tax benefits from the government. Housing is an essential need, okay? People have to live somewhere. Human beings have to live somewhere. No matter what happens with the economy, no matter how many differences AI makes, as long as humans are here, we have to live somewhere. And so we're providing an essential need to people. The government gives us tax benefits based on that. And we have a product that people have to buy. They have to live somewhere. They have to buy a home. They have to rent a home, rent an apartment. They have to live somewhere. And then syndication allows people to invest passively with professional operators. And that's what we do. And it allows you also to do that too. We'll talk about that a little bit later. Stability, it's a hard asset. So has the values gone down in the last few years? Yeah. In 2021, we were in a bubble in 21 and 22, and the prices came down. But there's always a limit to the downside on any kind of hard asset where people move in and say, hey, this is a real thing. I want to buy it. I want to get into it. And the last 12 months, the prices have been very stable. They've bottomed out, in my opinion. Diversification, things like apartment buildings are incredibly good diversifiers for stocks or bonds. They are incredible as far as being uncorrelated assets. So I'll give you an example. A lot of people don't remember this, but I think it was earlier in 2025, maybe in 2024, the market dipped about 12 to 13%. So I think the Dow was at 45,000, something like that. And it dipped down to about 38 or 39. It was a pretty significant, correction that we started having. Wasn't a bear market, pretty good correction. And at that time, my wife and I had moved most of our money out of the stock market completely. It's not all out of the stock market. We still have money in the markets. I never tell people to move all their money out of the public markets. I mean, I think it's great having liquidity. It's great having money there. I'm not a put all your money in real estate and take it out of the markets. But we had the majority of our money out of the market. And when that, people were telling me that I know their friends and family, they were really hitting the panic button when this happened. And for us, we were not panicked at all. It was really no big deal because I knew the market was going to come back. And our portfolio didn't change that much because our apartment buildings were not affected by this correction. It didn't make a difference at all. We were totally diversified away from it. Apartments have high returns versus the risk level. So our returns in our properties are typically going to be 15 to 20% a year. Can you make that much money in the stock market? No, not over a long period of time. If you want to look at 1 year when the market goes up 15, 20, 30%, those have happened, but it's rare. Generally, stock market returns are around 10%. And what we try to do in real estate is 15 to 20. So we want to do 50 to 100% better. And we want to avoid losses. And we'll talk a little bit about that. So the returns are on average much, much better than the stock market. And then they have a low correlation with stocks and bonds. This is that diversification. Stock market drops 10, 15, 20%. If there's some kind of an AI, crash that looks like the dot-com bubble, it's not really going to affect apartments. In fact, it will help apartments because the lower rates. No correlation with bonds at all. So it's a good way to diversify. It's a good way to put some money that's outside of those public markets that won't be touched if there's some kind of a crash. And then why is now one of the best times to invest? I think in real estate and multifamily, this is the best time in our lifetimes with the exception of the great financial crisis. So unless you can go back in a time machine to 2009 or 10 and go buy properties back then that were selling for nothing, this is the best time because it's already crashed. So the why when it's one of the best times is on sale. So right now, multifamily is down about 30% or more since 2022. Okay. So that's what originally got me extremely interested in getting in this business as a passive investor. And then I jumped in as a general partner. I'm a general partner right now in about 1,200 units of multifamily. And I really jumped in head first on this because I saw the market was down 30% since 2022. And to me, this had a lot of parallels to the stock market when I first got married. So to me, I was looking at, wow, this is totally fantastic. This market's crashed. I see value here and I want to buy into this market and get it on sale. There's a housing shortage. There's not been enough units built since the great financial crisis. We're about 4 million units short right now, according to what we've been told by experts. 3 to 5 million. I've heard a lot of different stats. Right now, there's not a lot of construction going on either. We're falling further and further behind because of interest rates, because of problems with demand. It's changing quite a bit, and we're falling further and further behind. There is a housing shortage, and there's a way to benefit by being an investor. Home ownership is now unaffordable to most buyers, 100% on that. Record unaffordability. I own a mortgage company. It's a side hustle. I still do mortgages, and it is extremely, extremely slow. I didn't do very many this year at all. Phone didn't ring a lot. And if you look at the difference between a mortgage payment versus rent, and this chart shows that the average rent is $1,781. The average mortgage payment is $2,432. And you can look, going back to the financial crisis, rent has been cheaper always until 2021. And then housing became more unaffordable. What does that mean? It means that people are staying in apartments longer. They can't go and buy homes. And they're staying there longer because they really just can't buy a home. It's totally unaffordable. And so this is a good benefit for apartments. Another trend is adults less than 40. They really prefer renting. They don't want to own anything. They don't want to go into debt. They don't want to save money for a down payment. They want to lease cars. They want to live in a really nice, classy apartment complex with a gym and a pool and a dog park. And they just enjoy that lifestyle. Also, with housing being more unaffordable, it's been very, very difficult for these people to go buy a house. And the way they look at it is, I go buy a house, my payment's going to double. I don't have a swimming pool. I don't have a gym. I don't have a dog park outside my apartment. So I'm going to be going and basically spending a higher rent, and my lifestyle goes down. So for these people, they don't like it. So how do we invest in these deals, or how do we make sure we have a good deal? So I'm going to talk a little bit about my proprietary method, which is called the DEAL method, DEAL. Obviously, it's an acronym. Okay, so what I do when I invest, I want to invest like Warren Buffett. So my first rule number one, is never lose money. Okay, I've never lost money on a deal that I participated in as a general partner, or I brought investors in. Okay, so my first rule is never lose money. Rule number two is never forget rule number one. So when you're going these investments, what you need to focus on is not losing money. Don't focus on hitting home runs or finding crazy deals that take a lot of risk where you're going to try to get rich quick. What I have found is the quicker people try to get rich, the longer it takes, because they have losses, they have issues, they have problems. So don't do that. And my wife and I have a rule number three, and that is never lose other people's money. So when I'm raising on these deals, I'm being very careful. We invest every deal. It's typically $100,000 of our own money in every deal, but it's really important to us to not lose other people's money. One thing that I do offer that I'm not going to go into too much detail on this call is a principal protection program. And if you're curious about that program, you can look that on YouTube. We do sell principal protection on our deals as an option. And when you invest with us, you can buy that if you're worried about losing money. And if you buy that, you'll never lose your principal. So the deal method, how does this work? What do I look at when I look at deals? I look at the debt structure. The loan type, is it a fixed rate? What's the DSCR? For those of you that don't do a lot of real estate investing, the DSCR is the debt service coverage ratio. And it's basically a ratio that tells us, is the deal cash flowing day one? Is it cash flowing day one? So the D is the debt structure. It's the loan type. I want a regular bank or Fannie Mae, Freddie Mac agency loan, anywhere from 5 to 10 years. I want long-term debt. I want it to be a fixed rate. The loan payment never changes. And I want a DSCR of 1.25 or greater. So it means the deal cash flows day one. The E is the experience and expertise of a general partner team and their track record. We don't invest with rookies. Okay, so I look for people that have been in the business 10 years. They have full cycle exits, and they have a big team built up that can handle any problem. They've had good exits. They have a good track record, and they're focused on protecting investor money more than hitting home runs. Then I look at the numbers on the property, the accounting, the returns, the metrics, the underwriting. I actually look at this last. Okay, so I look at the debt structure first, the experience level first, look at the location. Is this a market I want to be involved in? So far, all the deals I've done as a general partner raised money for have been Texas. So I do mainly Houston, which is my hometown, been here my whole life. And we've done deals in San Antonio also. I look at the submarket, I look at the neighborhood, I look at the area risk, and I look at the location. So after I've looked at these three things, only then do I look at the accounting, the returns, the metrics, the underwriting. Why is this? Well, the main reason is if you're fixed rate debt and you got a good debt structure and you got a highly experienced team, they're not going to buy a bad deal in a bad location. So the numbers, they're not unimportant, but they're the last thing I look at. And I'm just checking to make sure they don't look unreasonable. They don't look crazy. I don't see any anomalies in the numbers. But normally, yes or no on a deal is based on the debt, the experience, and the location. And I look at the accounting last. If I'm going to do a deep dive on the deal, and if I really think I want to buy into it, I might spend a few hours on that. But the other three I look at in the first 10 minutes and I can immediately say no. So that's my method. I say no to a lot of deals. I get sent deals every day. I'm constantly saying no. So let's talk about a deal that we've done. And some of the investors on this call may be investors in this deal. I saw a few people that signed up that invest in this deal. So I wanted to show you the type of deal that we typically do. This was Shadow Creek. This was purchased in August of 2024, 296 units in Houston, 7,500 Pinemont Drive, Houston, Texas. You can look it up. You can drive by there if you want, Shadow Creek. Don't go on the property if you don't live there. But you can drive by and take a look at it. This was purchased pre-foreclosure. It was going into a foreclosure. It was a $22.7 million purchase for the 296 units. The owner had paid $31 million in 2022. So they had bought it in the first quarter of 2022, paid $31 million. They had gone and spent $3 million in capital expenditures. That's why in this picture, the property looks so nice. New roofs, new paint. They really spruced the property up, made it look beautiful. Unfortunately, the type of debt they got was bridge debt. So it was variable rate debt. The interest rates went up in 2022. The debt became unaffordable. They were going into foreclosure. They're about to lose the property. We bought it for the loan amount, which was $22.7 million. A pretty good deal, about a 30% discount from the original sales price only 2.5 years before. And we got the $3 million in CapEx spending for free because he had spent all that money on it. We bought it. We got a new fixed rate loan on this deal, recapitalized. I think the loan's about $15 million. And then we cash flowed day one in this deal. And this deal is paying out distributions regularly. It's stabilized right now. And it's doing really, really well. And there's a whole lot of upside in this deal. And this is kind of typical of what we do. I like buying distressed properties, but I like it when the property itself is not distressed. We buy from distressed buyers who can't pay their debt payments because they got bridge debt and they just can't handle the new interest rates. Or maybe there's some other problem with the operator. They got to sell a property to save another property. There's a lot of that going on too. So this is very typical of the type of deals that we do. This one's very special to me because it's the first deal I was ever a general partner on. The operator is a fantastic operator, doing a great job on this deal. And I've done other deals with him since then. Okay, so next steps. If you want to learn more about this. So basically, the best way is to start getting educated. So if you're in Houston or North Houston in particular, we have a local real estate meetup that I bring operators into. And if you want to hang around people that are investors or you want to meet these operators and you want to have a real nice time, we have it at a local barbecue restaurant. You can look on my Facebook page and see the invitations on this or the locations on this. It's typically the third Thursday of every month, and we meet locally here in the Woodlands. If you want more information on that, pick out your phone right now and you can text me. My phone number is 713-516-1207. And then for a more extensive training on these investments and how to get invested and how to learn my deal method and learn how we look at deals and a little bit more on our story, you can do that online with YouTube. We offer this training for free. There's no charge. I'm not charging people for the training. We just want to give people free education. And that's on my YouTube channel. And the YouTube channel is the same as my name. So it's very simple. David R. Priest, Priest, is the way that's spelled. And you can get on there and look for Multifamily Masterclass Session 1. That's where you'll start. There'll be a little bit of a recap here from this on our story, and then it'll go into a deep dive on the legal, the terminology, underwriting, a deep dive on the deal method, how that really works. And this is all my best stuff that I have for passive investors, and it's a method that served us and our investors very, very, very well. So I got into commercial real estate late in life, I think. So I started getting into this real heavily in my 50s. I wish I had gotten to it in my 20s or 30s. I would be in a very, very different financial situation right now, a much better financial situation, but I learned this 20 years ago. So the best time to plant a tree is right now, or was 20 years ago, excuse me. The best time to plant a tree was 20 years ago. The next best time is right now. So it's time to start planning your future, planning your legacy, planning your family, passing this information down to new people in your family and set them up to do well. I had a friend of mine that told me, what you learned late, teach your children early. So I'm trying to do that in my own life, teach my kids about this stuff. And they may not want to be in real estate. And I get that. I'm not trying to press my kids into real estate. However, I'm going to teach my kids how to be incredible passive investors. So they're going to be wealthy no matter what they choose to do in life. They're not going to make decisions based on money. So here's our contact information. Me and my wife, this is my business line, 713-520-7700. I'll also give you my cell phone number so you can call or text or set up appointments or get my full contact information. That is the best way to reach me, 713-516-1207. And we do 100% passive investing on these deals. We usually have deals available and ready to go. And our philosophy is own everything, operate nothing. We're not operators. We don't want to operate properties. We want to leave that to the pros.